Hi, this is real estate attorney and legal blogger Roy Oppenheim from the trenches. I want to go over with you all today a little bit what's going on with the Obamacare real estate sales tax. There are a lot of misnomers out there that this tax is somehow going to destroy the real estate market, particularly the residential real estate market in the United States. And I want to make clear that, first of all, that is not the case. The only individuals who will be subject to this tax, and I know it's a little complicated, so just stick with me if you can, are those people who make $250,000 a year if they're married, with $200,000 individually. But it doesn't mean that you're automatically going to be subject to that tax. You have to have also made a $500,000 gain on the sale of your home. Now, maybe you know people who make $500,000 on the sale of their home. After all, most people have negative equity in their home. They certainly aren't going to be making $500,000 on their home. But let's just for a moment pretend you are one of those people who make over $250,000 a year as a married couple, and you do have a $500,000 gain on your home. If that is the case, the increment over $500,000, let's say you had a gain of $600,000, the increment, the $100,000 gain, would then be subject to a 3.8% surtax, sales tax, increase in capital gains tax, whatever you may want to call it, and thus you would pay 3.8% on the $100,000. But that would only be if you made over $500,000 on the sale of your home. And again, most people are underwater in this country. In Florida, half the people are underwater, and throughout the country, at least a third of the people are underwater. So most people aren't going to be making $500,000 on the sale of their home. And further, you have to also be an individual making $200,000 a year or a married couple making $250,000. So the reality is that this Obama